Hey guys, good afternoon and welcome to the CNBC TV18 Mumbai studio. I'm Pavitra. With me is Sonal. You're tuned into MF Corner. And today we're going to talk all about investing for high or ultra high net worth individuals. Now, this type of investor usually has a much higher investable asset. So, more money is being put to work. They usually have a higher risk appetite as well. And they also get access to some investment opportunities which are just not available to regular retail investors like you and me. But let's try to understand how much of a role mutual funds really play in HNI portfolios and where the HNI money is concentrated. So Sonal, this is not something that we've touched upon, but there is a lot of HNI money in all of these funds. So let's find out.
Of course, that's where the money flows in from a lot as well, right? So joining us today is Nimadri Chatterjee, who is the head of advisory and key clients group at 360 ONE Wealth. Good afternoon, and thank you so much for joining us on the MF Corner today. So let's start with the basics and start with understanding what are the basic characteristics of HNI individuals or investors. How are they different from regular retail investors who are going ahead and giving their money to Webi via the direct way or the regular way?
Well, thanks for having me. At the outset, I think the biggest difference for the ultra HNIs is that their financial goals have been met. Savings goals have been met. They don't need to draw down on their investments to meet any family needs or any big expenditures. And therefore, I think over a period of time, they have a better understanding of risk. They have a better understanding of what risks they need to take to meet aims for a certain capital that has been set aside. So it's not just a difference that the amounts are larger, the way to invest this amount is slightly different. And therefore, with ultra HNIs, what we see is that there is a more portfolio approach to investments as opposed to a product approach, if that makes sense. Yeah. And so they're trying to see how do I pass on this capital to the next generation, and how do I take the right investment decisions. Along the way come slightly greater differences. For example, they will have greater diversification between platforms. So mutual funds are very important, but they're not the only platform. So they will have investments in sophisticated platforms such as AIFs, venture capital funds, even large value funds, which most people are not even aware of. They will also have a greater allocation to fixed income. Typical retail or HNI investors, you can see the numbers, largely in equity-oriented schemes. For HNI segment, we find that roughly up to 50% would be in fixed income and hybrid categories. So the objective is not, I would say, maximization of wealth, rather it is optimized investment of wealth.
Yeah, and making sure there's no kind of capital loss. You have to preserve that wealth that has been created.
That is absolutely correct. So when we sit with our families, the first objective is wealth preservation, and then it is wealth optimization.
Oh, absolutely. That makes complete sense. But you were mentioning that mutual funds are a part, of course, of any, HNI portfolio. Take us through the role that mutual funds play and, a little bit more about how exposed are HNIs to funds, the kind of, within HNIs also there are multiple categories, right? Sure. Someone who wants to go more aggressive, someone who wants to focus more on preservation. Sure. So just take us through the role that these funds play in portfolios.
Sure. So mutual funds, like you rightly pointed out, they have an important role to play in ultra HNI portfolios, but it's not an all-encompassing role. All right. So if I just go through the biggest benefit of a mutual funds, what are those benefits? First, it is very liquid. Okay, you can just invest any day, and you can ask for your capital back on any day. All right, they're very well diversified. Okay, because they're investing in a pool of securities. They're very tax efficient, and for large portfolios, any leakage is a big leakage. So transactions done within the mutual fund aren't taxed. Dividends earned from underlying stocks by the mutual funds aren't taxed. And in individual hands, they would be taxed at 40%. So it's a big leakage. And also the costs, like in the PMS, etc., there are cost advantage in the mutual fund. So mutual funds offer a lot of these benefits, and therefore they're an important part. Now let's come to, I want to break this answer by asset class, if I may.
Yeah, sure.
And so when I talk about equities, within equities, we've seen a trend emerging. So if you look at the SPIVA report, for example, which is talking about how many mutual funds are outperforming the indices, it's becoming tougher and tougher. So if you look at the large cap space, okay, just about 10% of managers over a 5-year period are actually outperforming the benchmark index, all right? That number is more than 50% for the mid and small cap space, all right? So that creates an opportunity that for large caps, you do a mix between actively managed mutual funds and also passively managed mutual funds. Passively managed mutual funds reduce the cost and take some of the performance risk out of the equation. If I was to look at the other asset class now, fixed income mutual funds used to be the rage, right? But we saw a couple of changes in the budget last year where an unusually large percentage allocation to these fixed income mutual funds may not be the case anymore. However, they still have three large benefits. One, again, liquidity, again, diversification. And the third is because there are a large number of diversified instruments, an investor can very finely tune their credit risk that they want to take and the duration risk, which is how long dated instruments you're taking, between a basket of mutual funds and not have to allocate large amounts to every security. So that's why fixed income mutual funds, despite now the tax advantage not being available, are an important portion. The category that is coming up is hybrids, all the numbers you can see. The only point of caution, I would say, in hybrids is, though there's a tax advantage, is the fixed income should be of high quality, the fixed income component. It should be a large portion of the hybrid so that actually there is some material tax benefit. And the equity component should be managed by somebody who has a good track record over long periods of time. You don't want to get into hybrids just for the tax advantage and not get the performance in the first place.
Okay, all right, makes sense. So if we've spoken about so many aspects when it comes to HNI investing, right? How much is mutual fund a part of that entire portfolio, if you can give us in terms of a percentage?
So with your permission, I'll speak to our experience and the type of clients that we work with. So if I look at the types of portfolios we run for clients, they start from ultra conservative, going to conservative, then balanced, then I would say maybe moderately aggressive to aggressive. And the percentage allocated to mutual funds differs across these five. So if I was to talk about, let's say, an ultra conservative to a conservative investor, where the ask is keeping it extremely simple, just making maybe 200 bips above inflation in terms of returns, the percentage allocated to mutual funds is high across equity, fixed income, and there's almost no alternatives in the ultra conservative space. So let's say maybe 60 to 65%, let's say 2/3 of the portfolio across equity and fixed income will be allocated to mutual fund space for all the benefits I told you earlier, like liquid, easily understandable, low cost. When I come to, let's say, a moderately aggressive investor, I would say that number would fall to maybe 45% or so. Okay. The reason is a moderately aggressive investor is also allocating to other asset classes and other sub-asset classes. For example, unlisted equity, unlisted debt, REITs. So those are not always available on the mutual fund platform. So I would say between 45 to 60% or maybe 65%.
Okay. It's quite a significant portion. We also want to ask you, a lot of mutual funds, at least in the past few years, I'm talking about the mid, the small caps, have been able to generate pretty remarkable kind of returns. Of course, it's a factor of the market also being so solid. And sometimes these returns are on par with what PMSs are doing. If you look at a quant or something, it's pretty crazy. How do you compare this? How do you look at, how much money should go into a PMS, how much should go into an MF? Because like you were mentioning, PMSs are more expensive as well. Or is it that for certain kinds, maybe large cap MFs are better and, for small caps, is there any such thing?
It's a great question. I mean, right off the bat, I'll say there's no reason to assume that a PMS must outperform a mutual fund, all right? So therefore, the platform doesn't make something more superior, but let's understand a little more. Mutual funds have a phenomenal tax efficiency as a platform, all right? I mentioned them briefly, but I'll try and give a little more flavor to them. When a manager buys a portfolio of stocks and buys and sells, all right, there's some gain that the manager, when he buys a stock and sells, there's some gain. In a mutual fund platform, that gain is not taxed till the investor actually redeems his or her units, all right? So that gain is fully available to be compounded. That's one benefit. The second benefit is those underlying stocks, okay, are paying dividends. Those dividends are not taxed. All right. If I was receiving the dividends in individual hands, for an HNI, that would be taxed at close to 40% rate, ordinary income tax rate. Some of these benefits, by our estimation, roughly account for 1.4 to 1.6 percentage points per annum by way of saving. So any PMS has to first outperform by 1.4 to 1.6% to
Everything
come
has
at
to be
par.
over and above that.
Yes,
then.
so it has to do this just to come at par, and then portfolio selection. So therefore, mutual funds have a benefit. Now to the second part of your question, it's a very astute question, because again we see that there's a difference between large cap, multi-cap, and let's say mid and small cap. In large caps, the experience has been that most fund managers are not outperforming. There is no information asymmetry available anymore, etc., etc.
Also, the rules. You're not, the constitution of the index is a certain way, and you're not allowed to hold stocks in that way. That's why large cap fund managers are not.
That's an interesting question, which if I'm allowed to answer after this question, I'll tell you about why index is so powerful. But for large cap, therefore, we prefer the active and passive approach. Okay. So you do active mutual funds, but also some part of the large cap allocation you give to passive funds. They are equally liquid. And they drastically reduce the cost of ownership. And obviously for large portfolios, the costs are also large. For multi-cap, I think the mix between mutual funds and PMSs is where we find a sweet spot. For mid and small cap, okay, I think there is a different sort of a barbell. Either we will end up doing a lot more index investing, or rely a little more on PMSs, where there's a greater role for the fund manager to create alpha after accounting for the risk. And just because you got me started off on the index is actually a very efficient investment, because it's a moving goalpost. Every 6 months,
it adjusts.
Yes, you're absolutely right. So therefore, in a way, the best companies are constantly coming in, and some of the others are going out. So it's a moving goalpost. It's not so easy to continuously beat the index.
Okay, we take that point, and good we mentioned that and discussed that in greater detail. But we have to slip into a short break. When we come back, we'll continue our discussion on HNI investing and a lot more, but you stay tuned for that. Welcome back. You're still tuned into MF Corner. We still have with us Himadri Chatterjee of 361 Wealth. We are discussing everything about HNI investing and a lot more. You know, Himadri, we have spoken ad nauseum about small and mid caps last year. It was a remarkable year. How exposed are HNIs here in terms of a bigger exposure or a smaller one? What is your take?
Yeah, again, I'm just going to preface by saying I'll talk a little bit about the UHNIs that we work with. All right, and we mentioned this briefly earlier. But the primary aim for when families work with us is first wealth preservation and then wealth optimization. Maximization anyway doesn't come into the picture, all right? And so the primacy of the investment policy, creation of the investment policy and guardrails, it cannot be overemphasized. So for most of our families, we work with a plan saying that at the maximum, you can have up to 35 to 40% of your equity exposure in mid caps. Okay, in mid and small caps, all right. On an average, because most of our clients are in the balanced to moderately aggressive segment, I would say about 25 to 30% of their equity exposure would be in the mid and small cap space. And then there's another vantage point we can see this from when we run our asset allocation committee, for example, and we give guidance on broad asset and sub-asset class levels. Our target for mid and small cap, the median point is 27.5, which is 25 here and 30 here. So on an average, I would say about 25 to 30% of client allocations would be in the mid cap space. The other thing to note is we also run from time to time tactical models, which means that as markets may race ahead of themselves frequently, we are able to draw back a little bit and say that, hey, listen, there's just racing ahead of where fundamentals or earnings show where they are. So on the mid and small cap space, we may have taken some cooling off of the allocations, and while the values have grown, if we've just cooled off in terms of fresh allocations, there's a natural, I would say, reorientation towards the large caps away from mid and small caps. So So while values may have grown, the allocation has stayed roughly in that 25 to 27% range.
Got it.
Understood. You know, since we are talking about the markets doing so well, the fact that they've run ahead of themselves also, what is your outlook on the market, and are you at a stage where you are advising HNIs to take money off the table now to book profits, and maybe things are looking like they have run up enough?
Okay, good question. No, the simple answer is no, all right, for various reasons, but let me try and give a little more flavor. On the large cap space, okay, we think markets are fairly valued because the earnings in the large cap space seem to have kept pace with the markets, all right. So at 1 year forward, 3.2-ish number, I don't think we are way ahead of what long-term trends show. So 3.2 is roughly the average on the long term. We are at 3.2, 3.3. So we are not way ahead of where we should be.
Yeah.
So on large caps, our call actually is fairly valued. So we are where we need to be. On the mid and small cap space, at about 4.2 is slightly ahead of where we feel comfortable. So what we've done as part of our asset allocation committee and our call, 2 quarters ago, we started working on the levers a little bit. So 2 quarters ago, we said that we will slowly stagger any fresh allocations to mid cap. So our typical stagger for allocations is 3 to 6 months. We made it 6 to 12 months. And 1 quarter ago, we said an extremely long stagger for mid cap and no more fresh allocations to small cap. Okay. So just because markets are ahead of themselves doesn't mean that we need to take binary decisions of nothing or everything. But there's a lot of other levers one can pull. So for now, we are a long stagger on mid caps and no fresh allocations to small caps.
Okay.
We're still away from where we feel that we have to say book
It's too
profits.
much,
Yeah. If there are clients, however, where their small cap allocation is significantly higher than what their plan suggests it should be, their profit booking may be on play.
Okay, so if you can quickly tell us, what are the markets outside India that are looking good? Would you like China because of ultra cheap valuations?
Well, that's okay. That's an interesting question. In general, okay. Again, if we see it in the context of what can investors invest in, all right. First is typically the LRS limits, the liberalized remittance scheme limits. They're just so small. They're not material. So while clients make that allocation on a percentage term, it's not a needle mover at all. All right. The second is the feeder fund route on mutual funds that was available. That was always taxed as debt mutual funds, and last year's budget means they get taxed in an unfriendly manner at the maximum marginal rate, which means that incrementally as a part of your portfolio, using that route is not very efficient. You have to really outperform by many percentage points in order to beat the tax inefficiency. So there is a limited quantum, I would say, that clients will invest outside. Within that, I think for us, the US remains by far the most preferable market, despite the fact I'm aware that US valuations have also done well. Okay, China we've stayed away from. Okay, somewhere I think at the margin it's okay to invest a little bit in China, but for example, last year we have invested in Japan and had very good results. So just driven by valuation, I would say, is not necessarily the only metric because it's a narrow sleeve. I would say US becomes the largest, and tactically we may look at, we've done very well with Japan, we may look at China, but I would suggest tactically and not necessarily strategically.
But is this kind of international exposure something that you would recommend to a lot of UHNI clients, or just a few?
For sure, not only would we recommend, but there is also a big demand for it. I think COVID opened eyes for people that, hey, listen, we are stuck here and all our capital is also stuck here. So there's a big demand actually for not only investing outside, but also relocating capital outside. Some of which you're seeing in non-MF directions such as GIFT City, new ODI and OPI regulations and stuff like that. But yes, it's definitely a very big demand.
Okay, all right. It was such an interesting chat. We opened up a new segment altogether on MF Corner today. So thank you so much for joining us today. That's all about HNI investing and via mutual funds as well. But with that, we've run out of time on this show today. Stay tuned for Closing Bell to take you through the last hour of trade.